Lindsay. This meeting is being recorded. We'll call the meeting to order. It's February 24. It's the second day of our regular Board of Investment meetings. I'll begin with the roll call, please.
Good morning, everybody. Carl England,
Here.
Jack Prothero,
Here.
Jeff Greenfield,
Here.
Terry Cohey,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith.
Here.
All right, all 9 board members are present.
Thank you. So we know this is being recorded. Just a reminder. And then are there any comments? Public or otherwise, matters in board jurisdiction?
Chair, we're graced with being able to see Jeff Greenfield instead of his phone number today.
Jeff Meredith.
Jeff Meredith.
Yeah, I finally joined the Zoom revolution and I got the video working. So
Well, it's nice to see you, Jeff.
I don't know if it's an upgrade seeing my face rather than my phone number, but we'll go with it.
Well, since we're recording, we'll say it's an upgrade.
There we go.
There we go. Anything else from anybody? Any sort of follow-up from yesterday before we dive into the tab 8 and the investment reports? If not, John, I reminded Randy and I will ask Aaron and Michael, I think, are the only ones who are about to talk to us who haven't introduced themselves to the new board members. But if they would do so before they give their presentation, that will help people, help our new folks understand who's who. But John, you're up.
Sounds good. Lindsay, would you bring up the investment update slides? Excellent. So I think I've kind of met Mark and Jeff. I've certainly met Mark many times, but I'm John Putnam, the CIO. I've been the CIO for a little over a year now, and I've been with the board for a little over 16 years, serving in a variety of roles from equity analyst, fixed income analyst, public markets investment officer, and director of fixed income prior. So with that, go to the investment update, and Lindsay, if you'd flip to slide 4 to start out with. So looking at our assets and the changes that we've had over a variety of timeframes here, if we look at all the way to the left, the 1 year, you can see we started 2019 with assets under management of about 12.3 billion. Throughout the course of the year, certainly not in a straight line in 2020, we added about 1.4 billion in terms of both income and price appreciation of the assets. We paid out about 400 million to the various pension plans over that time frame and ended up with a balance of about 13.3 billion in assets under management. So you can see that same graph over 5 and 10 years, and would just note that we have managed to add to our assets under management under all of those time frames and pay all of our benefit needs. And I would also note that if you kind of did the rough math, you would note that our net cash need has grown slightly over time. So as we look at, these more recent years, we continue to see that net cash need grow slightly, and that's expected to continue at least over the next decade or so. I think last time I had seen numbers on that in a modest way, but it's something that we need to certainly be aware of as we are considering our asset allocations going forward. So if we turn to slide 5, we see the same numbers for the course of the year, but broken down by the asset classes. So we're looking at column 4, I guess it would be there, the dollar change, an overall increase in our assets under management of about $1 billion, and you can see, where that's allocated across the different asset classes. Clearly, we had an increase within each of our asset classes there, except for core fixed income and maybe just slightly cash. And that's consistent with what we've talked about with our asset allocation plan from November and even a little bit prior, talking about how, not a lot of yield in core fixed income these days. So we have moved away from that to some degree. Net cash flows there. You can see that we took primarily from domestic equities and from core fixed income over the course of the year. Obviously, that's been because domestic equities had a really good run, particularly at the end of the year. So again, not a straight line. We certainly weren't taken from domestic equities in the first quarter last year. Probably not even too much in the second, but the end of the year, as RVK mentioned yesterday, especially fourth quarter, was extremely strong. And then moving away from core fixed income, I would note that some of that move away from core fixed income was simply the change that we made right at year end. So basically right at 12/31, where we moved the TIPS portfolio into the new real assets portfolio. And so I don't know, just to make sure that Mark and Jeff understand, I know yesterday RVK was talking about the natural resources portfolio. So in November, when we were approved the new asset allocation, we changed the name of natural resources to real assets. And we made it a bit more encompassing in terms of assets that we look at there. So it would include still the commodities related strategies. But we moved TIPS, so Treasury inflation protected securities, into the real assets bucket out of core fixed income. So no real change other than thought that was a more appropriate place. And then infrastructure is an area under real assets where we are currently looking to add more exposure over time. So questions about any of that before I move on?
So how much of the $686.9 million was a transfer and how much was sales?
So roughly 150 million in TIPS went from core fixed income into real assets. So 150 million was just a transfer between the asset classes.
Okay.
All right. Slide 6. So slide 6, again, same basic breakdown, just showing you the various pension plans here. Obviously, public employees retirement and teachers are the two very large ones, and that accounts for the majority of our outgoing cash flows. You can see most of the rest of them were slightly negative as well, with the exception of firefighters and game wardens. And there's just different flows in the pension plans. The legislature, creates changes from time to time as to how certain things are treated. And so that's why there might be small differences there, but generally they're all moving relatively in the same direction and overwhelmed by what public employees and teachers are doing broadly. Moving to slide 7, performance in terms of our percentage returns here, obviously an extremely good one-year return, fairly unexpectedly, I guess I would say, as RVK talked about yesterday. You wouldn't think in a year where we had a pandemic, we would be showing a 12% return, but we'll take it. Aside from that, I think as always, the longer term returns are really the more important number that we need to be looking at. And, very solid returns over 3, 5, 10 years. And probably most importantly, since inception, hitting our actuarial required rate of return across the board.
Mr. Chairman?
Yeah.
John?
Yep.
So again, same question I asked yesterday, is this calendar year or fiscal year?
This is calendar year.
Okay, thank you.
So each time that we do this, Mark, when we try to you'll basically see these same slides, every time we do a quarterly update, it will always be a one-year look back.
Okay.
So.
I have a question, Mr. Chair.
Sure.
The pension returns, I know that we had I was quite concerned about the cash allocation in our cap. And I know that we worked hard to change that, and I wonder if I could just get a summary of how that changed our cash position overall.
Sure. So as you recall, we had a pretty high cash position, let's call it, mid to late 2019. We were in the process of bringing that down. I'd say we brought it down considerably into, early 2020. It was still slightly elevated, but currently, the basic plan, and we've been pretty consistent about it, is we keep 1% cash at the pension plan level. So their STIP accounts are generally 1%. And each month, as we kind of have flows, Aaron and the operations team rebalance to that amount. So we kind of have that 1% available. So that 1% for them, I would say roughly represents 3 months of benefit payments, ballpark. And then at the cap level, we of course have cash as well. And that we monitor more closely in terms of, do we want to have cash there, or do we want to deploy it into other areas? I would say we're generally at least another 1% in cap to kind of handle any flows that would happen within the asset classes, i.e. are there commitments that are getting called down from the private equity or the real estate managers that we need to fund. So that's always available. More recently, as we've seen, asset prices get quite expensive, we probably moved that more towards the midpoint. It is sitting currently a little above the midpoint, a little above 3%. So we've got, call it 2%, maybe a little bit more in the cap portfolio, and then that other 1% in the pensions themselves. Does that answer your question, Diane?
Yes, it does. Thank you.
Sure,
Can I follow up, please?
absolutely.
So that's the amount that you've got internally in cash, correct?
Correct. So external
What about the
managers,
look-through to the managers.
you're right. We really can't control what the managers have, but typically most of them, we have limits, I would say virtually always in any of the contracts that they can't carry large amounts of cash. Most of them don't want to carry large amounts of cash because that's generally going to be a drag on their performance. So it's a fairly negligible amount usually.
Good. Thank you.
Sure. Yeah, I can, if you want to just click it off. Any other questions on anything there on performance? All right, we'll roll forward to slide 8. So this is just performance broken down by the various asset classes. RVK talked about this yesterday. Pretty good performance across the board within the asset classes, with the exception of real assets, or as I noted, natural resources, as they had it listed yesterday. As I think Becky said, driven largely by our exposure in that bucket to energy, particularly oil and natural gas, that took a real hit over the course of the last year. Real estate kind of hung in there, but not a lot of return at the end of the day there, but everything else, quite strong. Questions about any of the specific asset classes there?
So John, at the end of the year, that oil and natural gas came back though, didn't it?
It did, but it still was quite a down year overall.
All right.
Didn't come back in the way that many of the other asset classes did, nor did real estate as much.
Okay.
Slide 9. So this is where we were positioned at the end of the year relative to our midpoints. So a little overweight the public equity sectors, a little underweight in the illiquid asset classes, as we just can't get money in there to keep pace with the strong markets that we had. We have the other board members that have been here a while, so, you know, you've certainly seen core fixed income, as we saw it on the prior slide, come down. So I would say last year we were probably, well, we had a different range. It was 15 to 25. We were closer to that 20. We're now getting closer to the midpoint of the core fixed income at 15. Much of that has gone towards non-core over that time frame. We've continued as we entered 2021 here, and equity markets, you know, stayed strong. Throughout the rest of the year, we've been trimming. I mean, that's an area where we've been trimming domestic equities. So sitting today, we're still overweight domestic and international equity, but maybe more like 1.5%, in that ballpark as we kind of trim there and search for places to put money where there's still some kind of an attractive return, which is a difficult equation to solve for at this point in time in the markets.
So John, these are year-end figures.
Yeah.
I don't expect exact figures or anything, but is there any changes from year-end to where we're sitting today?
Not
Just on a broad.
Yeah, not substantially. So today, as of yesterday, I guess I should say, we're 1.5% overweight domestic, 1.8 overweight international. We're a little more underweight private equity because we haven't had capital called down, about 2% under, about 1% under on real assets, real estate, about 0.5% under. We're about neutral on core fixed income, getting close to neutral on non-core, and pretty close to neutral on cash.
Good.
So,
So I haven't stumped you. That's good.
no,
But that's an indication. Do you think our systems are capable of getting you the information in real time that you need?
yes, we spent a lot of time over the last year or so, Aaron in particular. Thank you, Aaron. Aaron's a wizard with getting the data down in a lot of ways. But I have a number of things that I can look at in the morning. Cash, as Diane was asking about earlier, is one of them that we have a spreadsheet now where I can look at it every day and see how much cash do we have, you know, what's coming up, and ops can see it. I mean, more importantly, they look at it very regularly so that they're aware of incoming, you know, capital calls or other things that we may be doing, and making sure that we move money in a timely way to make sure that we're not bouncing checks or anything. We're in a good shape, but yes, I think we're in good shape there, Jack.
This is a helpful chart, by the way, just to see where we are. It's just a nice snapshot.
Yeah. I basically have, well, I've got it right here. I have a version of this that I look at most every day as well, just to kind of see, especially if the market's moving strongly, decide if we want to take a little off or what have you. Okay, moving forward to slide 10. RBK talked a lot about many of these concepts, but I like throwing some of these slides out that show kind of the big picture, I guess, over the course of the year. So 2020, clearly a difficult year in terms of GDP. It was the worst decline that we've seen since the Great Depression. So you might ask yourself, well, why did we do so well in the markets? As RBK talked about yesterday, basically it's the expected growth that we're seeing, you know, that the market's anticipating in 2021 and 2022. So currently expected GDP growth for 2021 is expected to be 4.9%, which is, you know, probably at least 2 times what we have typically seen, you know, over the last decade or so, since 2008. And then, you know, continues to be expected to be strong even into 2022 as we release some of that pent up demand. If we go to slide 11, you can see we still do have a long ways to go. So the unemployment rate is the blue line at the bottom there, still high, certainly relative to kind of longer term history. And we see a couple of recessionary periods that we had in the past there, kind of the 02 and 08, 09 timeframe. And then I always like to look at underemployment. So underemployment being the unemployment rate plus people that are working, but they're only working part-time but they would like to work full-time. They just can't find a job that take them. And that can sometimes be a much bigger gap than the unemployment rate itself, and is a little bit harder to close. So,
Oops.
go ahead, Bruce.
Yeah, John, last year we talked on pretty continually, once the market started to rebound, about how there was kind of a concern that the increase in the market was fairly narrowly based with some of the big tech companies. But it seems like I read in either the RBK stuff or your stuff or somewhere, or maybe I made it up, but that toward the end of the year and maybe into this year, the market has shown some signs of broadening out. Is that?
I think that's a
Did I
fair
make
statement.
that up, or is that, did I actually read that somewhere?
No, I think that's a fair statement, and I think you might have read it in some of Randy's stuff. I think he's probably talked about that maybe in his write-up. But yeah, we've seen certainly the tech companies benefit hugely, and I got a graph here in just a second that'll show us a little bit of that. But we have started to see some of those sectors and areas that have been, you know, I guess value for lack of a better term, but you know, the ones that have been left out of that enormous run start to come back a little. And I think that's sort of a function of both the growth stocks, the tech stocks in particular, being extremely expensive, and the idea that now that we have the vaccine and we start to open back up again, well, you know, Dan's talking about it over here. He wants to go to Disney World. So, you know, presumably he's going to go to a hotel and go to a restaurant and those sorts of things that we haven't done for a little while, or not in the same way that we were. So yeah, some of those broader companies in the economy may be starting to benefit from that, and hopefully will benefit more as we get to a more normalized environment over time.
Okay, thanks, John.
You bet. So if we look at slide 12, again, this is something that RBK noted, and I really kind of like looking at this in the graph, because it's pretty dramatic, I guess, when you look at, for instance, let's look at the red line first. So this is the total assets that are on the Federal Reserve's balance sheet. You can see, if you look back at 2008, when they came into the market and started buying securities and providing liquidity to the market during that time frame. And you can see it's just a multiple of that, and the speed with which they did that. So you can see we were well into a recession in, you know, kind of 2008, 2009 before that actually sort of happened. I mean, this line takes off immediately. So as soon as we hit that pandemic, I mean, they responded immediately in March, and that's why we saw such a gigantic rebound as they started to buy, you know, treasuries, mortgages, ETFs, you know, everything under the sun virtually, and supporting the market. And in addition to that, we see in the blue line, the debt of the US as a percentage of GDP. So this would be driven in part by, you know, what the Fed's doing, but largely by what the federal government's doing in terms of stimulus. And so again, we see a huge move by the Feds to come in and help support the market and fill the hole, as RBK was talking about yesterday, from the lack of income and consumption that occurred due to kind of the shutdowns. So it's very, very dramatic, and it continues to this day. And as I was on a call with Mr. Ramasco the other day, he was talking about, you know, the axiom of don't fight the Fed, which basically means that, you know, the Fed has, you know, multiple trillion dollar balance sheet here, much bigger than ours. And we think they're probably going to be successful in inflating, or at least sustaining, asset prices. And hopefully, from their perspective, that drives economic activity and ultimately lowers unemployment over the longer term. If we go to slide 13, this is kind of exactly what you were talking about, Bruce. And I think it's just, everybody talks about it, but it's a nice representation of the idea that the red line being more the electronic online shopping took off as people were stuck at home. And it's a trend that was already happening. You can see that red line was an upwardly sloping line, and the blue line, which is restaurant sales. That's kind of a proxy for more the brick and mortar economy. It was not doing poorly, but it wasn't going up as fast as the red line was. But the pandemic kind of supercharged that whole idea. And there's at least some thought in the market that that'll kind of continue, or the online sales aren't necessarily going to go away just because things open back up again, because people have gotten used to some of those conveniences. I was talking to Kirsten yesterday about, she's ordering her groceries or something, having them delivered to her house, and likes it. So will probably continue. So a lot of those trends are probably here to stay. So maybe finally, if we look at slide 14, I think one of the other big debates in the market right now is, given the stimulus and the aggressive stance that the Federal Reserve is taking at the moment, are we going to see more inflation? The Federal Reserve has been fairly clear that they're willing to overshoot a little bit more this time so that they can make sure that we get back to kind of their 2% target. So if you look at the blue line is what we call the real rate of return. So if we're looking at treasuries, typically longer term treasuries, say a 10-year treasury, minus what's the inflation rate, currently we come up with a negative number. So in other words, if we invest $1 in a treasury, a longer term treasury at this point, the expectation would be right now that we would have less buying power when that treasury matured than we would if we just spent it today. So we're not even keeping up with inflation. So that's kind of, a big reason why we've moved away from core fixed income is that inability to keep up. But if you look at the red line, obviously a huge dip kind of in the March timeframe as things started to get bad and we shut down. But because the Fed and the federal government has pumped so much stimulus and money into the economy, the market is starting to project that we're going to have, at least for the short to intermediate term, much higher inflation. And so you're seeing a little bit of struggle in the market even today as interest rates have started to kind of creep back up. And it's that fight between, are we going to be able to push inflation higher or not? But there's kind of a wall of money out there, if you will, that suggests that they may be successful at some point. So questions to that point? All right, so slide 15. Just a quick update, I guess. A lot of these I've probably already talked about, implementation of our asset allocation that you approved in November. That's going well. We got that done. It basically as the year rolled over. So we did it kind of right as of 12/31. Still a number of things kind of in process there as we got to adjust some of the performance things and things like that. But Aaron and Ops doing a great job of working through all that. So I think we're in good shape there. We did add preferred securities and emerging market debt, as Jason talked about EMD yesterday. In the fourth quarter, added both of those strategies to our non-core. So we started with 75 with both of those. And then just a couple weeks ago, we added 50 to EMD and 25 to preferred. So we're at 100 and 125 in those two strategies, and room to do a little bit more should we see opportunities there in the future, but probably getting close to at least a
John,
good.
remind me again what we define in the preferred securities bucket.
So preferred security, so that's an individual strategy, an individual manager that's in the non-core fixed income bucket. And so preferred securities are kind of an equity debt hybrid. So they have a dividend, which typically gets paid out regardless of whether or not common stock dividends get paid out. And and it tends to be it's a higher number. So I'm trying to think back. I think the quote unquote yield there on our preferred portfolio is, call it somewhere in the 5% ballpark at this point in time. So that would be significantly higher than, say, common stock dividends, which on the broader market might be, call it around 2% typically. So it's kind of an income play, but it's still an equity-like piece.
Thank you.
Bet. Due diligence, we talked about that a little bit yesterday and things. Obviously, we've taken a small number of trips. We're going to remain very selective there. We'll do it as we need to. Hopefully, things will open up a little bit more in the second half of the year. My guess is we probably don't get back to a full normal of travel until 2022, but we'll play that as it comes.
Is there managers in Florida in the summer?
Right around July 23rd.
Right. He can Zoom.
Like Florida in July.
Right. Hopefully you get in and out just before hurricane season.
I'll lose my COVID weight 1 pound at a time this way.
Ongoing rebalance within trust fund and state funds. So trust funds, continuing to move more into the real estate strategies as we're able there. State fund, again, I'm confusing my meetings here. We had a meeting with state fund actually on Monday where we gave them an update. But we've made some progress on adding mortgages. As you'll recall, we changed the benchmark there to the intermediate ag rather than just the gov credit. So added mortgages to that exposure within their portfolio. That worked out pretty well, I think, earlier in the year as mortgages looked a little more attractive. So we were able to add a fairly good amount there, but then more recently it's been less attractive. But we'll continue that process slowly as we have things roll off and things look attractive there. So going well, I think. High yield fees. Maybe recall from our CEM benchmarking study, we looked a little high relative to peers with our high yield fees. So, kicked off a process and we're in discussions with managers driven by RBK helping us with this. They had some good ideas about how to perhaps bring those fees down. So we're in discussion with our high yield managers currently, and I think it's going well, and hopefully we'll have more to report to you in the future on that.
When you do a negotiation with them, is our leverage, we can leave?
Absolutely. Yeah.
And what is their leverage?
Well, they have, we've selected those managers for a reason. So presumably they have a good staff, a good program, and we want to be there. So, they're not, things aren't completely interchangeable, but it isn't like there aren't other high yield managers out in the universe either. So, at the end of the day, we have to come to a mutually beneficial agreement. They have to be able to manage the business. It's an interesting space because, as we've talked about before, there's really no viable passive strategy there. You can look at the ETFs and things like that, but they don't really mirror the benchmark either. In fact, the ETFs tend to do far worse than the managers themselves. So there's an attraction to having active management there. But yes, at the end of the day, there's always another manager that we could go to if it becomes, in our view, unattractive to remain with that manager.
Yeah, and just to add really quickly, there are two issues. Probably not adding too much what John said, but there are two issues. The one, I mean, you look at the benchmarks and the fees overall are high, so we want to bring those down. But we also want to align incentives. So if the strong preference here is going to a performance-based fee, where you know they need to outperform in order to get a fee that is you know, potentially more attractive to them. But if they don't outperform, you know, Montana saves a little more on a little more than under a fixed fee schedule. So that's the goal. And you know, I think you do have a lot of leverage. But again, we want to make sure that this is, you know, incentives are aligned, so it's mutually beneficial.
Are there pitfalls in the incentive?
If you don't design it well, there are, but I think we're being pretty careful in terms of designing it well.
And what's just, I don't need to know all the details, but what are what do you mean design? I mean, what's well designed versus poorly designed?
Well, I mean, you just want to make sure that you have, you know, one example is making sure that you're protecting the long-term and the short-term. So, you know, we're designing incentives where you can't just blow it away one year and then lose it all the next year and, you know, get an incentive fee one year and not get hurt the next year. So we're designing things that take into account longer-term performance and short-term performance. That would be an example.
Okay, thanks, Mark.
All right, and then I guess just lastly here, you know, continued effort to improve our processes, cross-train people, and develop our succession plan within each of the asset class teams. With that, I'll take any other questions you've got for me. Otherwise, I'll turn it over to Aaron for macro attribution.
John, this is Terry. This is not a question, it's just a comment. I really, really like the format of your reports. I think it's really, they're very clear and really interesting. Thank you.
Thanks.
Mark, did you have something?
Yeah, so John, on the high yield, how much do you have in high yield now in total?
Roughly off the top of my head, Mark, it's probably about 575 million.
Okay.
There's a little under 200 in each of the managers. We've got three managers.
3 managers?
Yeah.
That's all I needed to know. Thank you.
Sure.
Okay, anything else from anybody before? Aaron? Well, good morning, Aaron.
Good morning. I'm Aaron Kirpin. I've been the Director of Investment Operations since about October. Prior to that, I've been here for, I think, about 7 years now. Now, to go over macro attribution, it's a little confusing, but essentially what macro attribution is an attempt to attribute our 1-year return of the pensions to the different levels of the investment decision-making process. So how do we break down the 1-year return of our pensions of 11.9% for this last calendar year? At the top of that process is our strategic asset allocation. So you, the board, have set ranges for each of these asset classes. Now, what this top level strategic asset allocation says is if we were to be invested at the center of those ranges in each of the underlying benchmarks of the asset classes, what is the approximate return we would have earned? For this period, it was about 12.7%. And that just basically says what is the potentially passive return we could have earned if we had been invested at every single day at the midpoints of our asset class ranges in the underlying benchmarks. Now, the next range down, the next decision-making point down is the tactical asset allocation. So we're not able to be invested at the midpoint throughout the year, certainly every day. And it's not necessarily possible to be invested at the midpoint for each asset class, even if we wanted to. For example, in the private asset classes, we can't just move to that midpoint because it takes time to to sign up new managers and for them to call down capital. So throughout the entire year, we're not going to be perfectly on the midpoints of each asset class, even if we desired. Now, with those ranges you have given us, we do have the ability to underweight or overweight the asset classes if we think there's a tactical reason to do so. We don't generally do that. When we rebalance, it's typically right around the midpoint. But if the attribution return to the tactical asset allocation, if that were large, it would show you that we are making large bets one way or another. And as you can see, it's been about 50 basis points for the entire year, which is relatively small. So what that should tell you is we're not really making any large bets based on the asset class ranges that you've assigned us.
Let me interrupt you for just 1 minute. Not that I don't trust you, but Mark or Becky, is 51 basis points small?
All right, I just stepped out. Can you, I had stepped out for a minute. Can you,
Uh-huh.
The only advantage is
a little too much coffee, sorry.
Okay, well, we're looking at page 16.
Yeah, I'm on the page. I just missed the comment.
Okay, and we looked at this heading of tactical asset allocation.
So I think the question was, Mark, so, is the attribution tactical asset allocation of 51 basis points, is that relatively large? Does that indicate that we are making any sort of large bets relative to this?
Yeah, I mean, my comment would be more looking at the actual allocation versus targets. You don't make significant tactical moves. Now, if you're off target, you're never going to be perfectly on target. And when you have an asset class like private equity, where the tracking error, as you well know, can be very significant, that can drive 51 basis points does seem, it depends on the time frame, but it does seem a little high. But my guess would be it's probably driven by some of those illiquid asset classes that aren't a good benchmark, that there isn't a good benchmark, and therefore there's tracking error that's driving it. So it's not like you're taking a big bet. It's just coming out in that part of the attribution. That would be my gut.
Okay, thank you.
Yeah, just to add a little bit more to that. So the strategic asset allocation is assuming that we are being invested at that midpoint every single day. Now, especially in a volatile year like 2020 has been, those asset classes are going to drift a little bit, especially, looking at the public asset classes, and that's going to cause a little bit of that tactical return. Now, we did rebalance more than usual during this year, just because of those sort of drifts, in an effort to keep that, basically that just to get back to our midpoints best as possible. But that's kind of basically where that shows up.
Okay.
The next decision making to point down is the style selection of our asset classes. So for generally just domestic and international equity, and to a lesser extent natural resources, we have assigned benchmarks to our external managers, and those benchmarks are different than what the top level asset class benchmark is. So using international equity as an example, the asset class benchmark is the MSCI ACWI ex-US IMI. Some of the underlying managers we have assigned international growth indexes or value indices, in domestic equities, and that there's small caps, those sort of things. The choice of those benchmarks, how they do relative to the asset class benchmark, will either add value or detract from value. So looking at domestic equity as a whole, our choice of the benchmarks to assign the managers reduced the overall pension return by about 23 basis points over the year. Within international equity, the choice of those benchmarks increased the pensions return by about 25 basis points. for the entire year. And overall, it was about 10 basis points across all the style selections, across all the asset classes. I'll pause there. Any questions on how that level works?
Okay, so a question for me, Aaron. So that style selection, that's a style selection by board staff? Or in
Yes.
negotiation with managers?
So when we're going out researching managers, some managers have managed certain benchmarks very well. So that can drive that process somewhat. But we do have some biases that we choose. For example, in domestic equity, we have a generally a small cap bias, and that is partially driven by our choice of assigning a benchmark to a certain manager.
Okay.
Okay, and so yeah, the final level is our manager selection. So what this tells us is what did the individual managers we selected within each asset class contribute to the overall pensions return. So looking at them individually, domestic equity, there was a large cap manager, 130/30, that did pretty well in this last year, and there was also one that didn't do real well. There's also a small cap underperformer for the year. Now the well-performing managers somewhat canceled out the poor performing managers for a very small selection effect throughout the year. Within international equity, there was some well-performing growth and value managers, and one poor performing growth manager that overall to the pension's overall performance added an additional 8 basis points of return. Within core fixed income, our external manager Reams was the primary contributor to our outperformance of the year of 15 basis points. The other manager there is basically our internal management, which added about 3 basis points to the overall pensions performance. Within non-core fixed income, none of the external managers materially contributed to the overall selection performance, basically meaning they managed pretty closely to the benchmarks they were assigned. And lastly, within private investments was the primary contributor to the manager selection underperformance of our non-publicly traded investments. And this is to be expected. The private managers are never going to be very close to their benchmark, just given their illiquid nature and the differences between the benchmark and their underlying investments. So over the year, we're going to expect this one to fluctuate quite a bit. And that's also given the lag in pricing of the underlying assets as well, which lags its publicly traded benchmarks. Does anybody have any questions on the manager selection?
Chair, I have a question.
Sure.
I'm looking at the small cap underperformance and wondering if we're successfully negotiating and what their charges are.
So we have, I might let Randy kind of contribute more on the selection of the overall managers. But we do have a somewhat of a bias, a style bias towards small. For the individual managers, I'm not sure which ones are underperforming or well-performing based on this analysis. So, I might allow Randy to kind of touch on that when he gets to the public market section.
That would be fine. Thank you.
You want to wait till then, Diane?
That'd be fine.
Okay, or we could do it now. I mean, it's up to you, Diane.
I'm fine waiting for the public.
Okay. All right, Aaron. Thank you.
Okay, thanks very much.
Well, so, I mean, I didn't mean to cut you off. I haven't cut you off, have I?
I think that's all I had to really present. The rest of the charts just kind of explain what I've I've been discussing.
So, from our level, what's the takeaway from this?
I think the takeaway would be, looking at each of the tactical style and manager selections. Those are primary the decisions that we as staff are making. The tactical asset allocation, as we discussed, is relatively small. It's probably a little bigger than normal, just given the volatility in the past year. The style selection, it shows you that the benchmarks that we've chosen, especially, this is really just within the publicly traded assets, are not adding a lot of value one way or another at a net basis, but within the individual asset classes, those can be a little bit larger. And, looking at domestic equity versus international equity. And finally, the manager selection. On an aggregate basis, this is going to be primarily driven by the private investment managers because of their returns versus the publicly traded benchmarks are a pretty imperfect proxy. But we can see overall that in certain asset classes, which managers are contributing materially to the overall pensions level. So it's really kind of a tool to look at which asset class there is helping the plans overall. I think that's probably what I would take away from it.
Okay.
So Carl, I might just add to that just briefly. I mean, I think this is a fairly good representation of what RVK was talking about yesterday with the idea that the strategic asset allocation, what the board does when we look at that each year and decide on our ranges and our midpoints, that's really what drives the majority of the return that we're going to see in the portfolio. And I think to Aaron's point, tactical asset allocation in particular, maybe a little bit on style and manager selection is kind of a double check for you to say, I mean, if you were seeing really big swings in particularly tactical, if that was making up 30, 40, 50% of this number or something, then I think, it's legitimate for the board to be asking, why is that the case? What are we doing differently in the portfolio that's making that such an important piece of our return one way or the other? So I think
does it matter the time frame? I mean, should we be looking at this 1 and 5 and 3 years, for example? I mean, I'm not arguing for more. I'm just asking.
No, it's and Aaron can probably speak to this better than I can, but it's difficult to get meaningful numbers if you look at it for really much longer time frames than this. I mean, we kind of settled on a year, I guess. We could do it, and Aaron has done it in the past. When we started it, we were doing it quarterly because we didn't have data to go back, further in a easy format, the way he's kind of built this thing. You could technically, I think, do longer numbers, but I think it becomes less meaningful because then you're combining larger timeframes where tactical asset allocation, that kind of washes out over a longer time frame. Tactical being what did we do more in the short term to the portfolio one way or the other.
Yeah,
Sure.
I'd add that we could show that. We might need to cite some more notes about the reasoning behind the numbers and that sort of thing. So it's possible, but.
Mr. Chairman, I have one comment, if that's okay.
Yeah, you bet.
Yeah, and I mean, John, definitely correct me if I say anything out of line, but one way to look at this, I mean, it is backward looking, and you can isolate some of the sources of contribution to return, and like John said, most of it's going to come from strategic asset allocation. In terms of decision making, we talked about this a bit yesterday, but the strategic asset allocation is driving most of the return, and that's really long term. And what has really helped you is one thing that you've done well, which is allocate a lot to equity, and that's helped you quite a bit over the past 10 years, and not allocating to a commonplace that's been a drag, namely hedge funds. So, that is going to, if you have a bear market that, you're going to probably lag and you have to prepare for that. But that strategic asset allocation is designed to align with your long-term objectives, and you can afford to take more equity risk. You need to take more equity risk in order to hit that expected return. And then the other, the tactical asset allocation, it's less about the number. We know from working with staff and with this board, you're not taking tactical bets. So, that's really just largely frictional. And then the style selection and manager selection kind of go together. And it's just kind of an aggregate measure of, are the slight tilts, and they're not making huge tilts, but are they, adding or detracting value? And then, are you picking good managers? There is some noise there from the private equity. I don't know if that adds anything, but the thing to keep in mind is that strategic asset allocation, the big bets in this, well, not bets, the big positions in this portfolio are that equity exposure. It's paid off, and not having some of the, some of the asset classes that have detracted from return. But that could shift as the environment shifts, but it is consistent with your long-term objectives.
Thank you. Others?
I think
Yeah.
Jeff,
Yeah, I have a question. So in regards to the manager selection on private investments, is that something, obviously you said kind of the performance is lagging because, that allocation is somewhat new. As that allocation seasons, should we expect, that to start to kind of outperform, or is that typically just, long-term underperformance?
I would expect there to be selection effects on the overperformance and underperformance at different times. So that's really driven by, so the private assets benchmark is a publicly traded benchmark, and the returns of our private asset managers, the pricing of those assets is lagged. And so if, for example, if the public equity markets are on a tear, the private asset managers won't have their positions priced for 3 months after that. So it'll appear as though they contributed to an underperformance, but that's really just because the assets aren't priced on a daily basis like the publicly traded assets. So to follow on to that, if the public equity markets is very poor for a period of time, say a year or 3 months or whatnot, the private assets would lag that pricing and then therefore would show an outperformance effect. So on a longer time frame, it becomes more meaningful. The benchmark for the privately traded assets, the private assets. So on a short term, we're going to expect some noise, no matter what quarter or year we're looking at. If that makes sense.
Yeah, that works. Thanks.
Somebody else have something? All right. Go, Bruce.
Yeah. Back to this discussion of the midpoints and the variation from the midpoints, John, Aaron, seems to me that we actually just adopted those midpoints last year. Does the recent adoption of those midpoints have any effect on what we've seen so far? And is there a chance that we will see something more predictable over time?
I don't think no big effect there, Bruce, other than for instance, we moved the midpoint pretty significantly within core fixed income. We moved it down. We moved a lot of the other asset classes up just maybe a 1%. So there's obviously there's a time there where we didn't move all that at once. We kind of did that over time, and quite honestly, part of our move to the midpoint in core fixed income has simply been driven by the fact that the equity markets did so well, and we just didn't, we did take some away from core fixed income, but part of it was just the denominator effect. Domestic equities and international equities took off, and so they became a bigger piece of the pie, and therefore core fixed income became smaller just by the law of the numbers. So I don't think it will change too much going forward. I guess anytime we made if we ever made any other, significant shifts like that, maybe that would show up for a while because we were further away from a midpoint. I guess I don't look at this type of stuff too much. It's not something that drives the decision making of the portfolio on a day-to-day basis, other than to say, yes, I'm looking at the midpoints and I think about, okay, well, we're trying to get maybe closer to the midpoint with core, and maybe domestic and international are a little above the midpoint, and I'm comfortable with that for the moment because of the environment, but maybe I don't want it to run too far, so we'll keep it, within a range, but it's not particularly precise, I guess, on a day-to-day basis.
Okay.
I hope that helps.
Yep. Thanks.
Sure.
If there's no more questions, I would hand it to Michael on page 19.
Could I just make a comment? Because I always like time. And when you're doing this and putting it on the agenda, at least to keep me calm, can you give yourselves way more time? Because I'm expecting you to be over or done now.
Duly noted.
Okay.
Morning, everyone. I'm Michael, Jeff, Mark. Nice to meet you over Zoom. Welcome aboard. Hopefully we'll meet you in person sooner rather than later. A little bit of background on me. I'm the director of private equity. I've been with Montana for just over 4 years now. Originally came from Portland, Oregon. I was there as a research analyst working in privates for 5 years prior. Grad school, undergrad in Portland as well. Spent 4 years in a traditional analyst program, so classically trained, and I've been having a good run at Montana. Love it here. I'll pause there with my background. I'm on page 19, market environment for private investments. Feel free to interject if you have any questions or I'm going over any terms that are not familiar. Private equity deal flow and exit flow for 2020 finished pretty strong. It was fairly tepid in the middle of the year as a result of COVID, as you would expect. It's our expectation that deal flow and exits have accelerated and will continue to do so into 2021. I think the end of 2020 was fairly strong, but the number is probably still even low. I think a lot of transactions were completed for possibly tax purposes with the new administration coming on. And so there were some transactions done, but in speaking with our managers, I think the expectation is there will be more transactions and a backlog from 2020. Bullet point 3, valuations for the fourth quarter remained high compared to historic expectations that will continue. Leverage and bullet point 4 for buyouts came at 6.3 times a multiple of EBITDA. That continues to be the case. That's an expectation for 2021. Leverage and debt is available for companies that have good balance sheets, and that leverage is available. Fundraising, a little bit of a mixed bag here. I think from our experience, 2020 was a pretty slow year for fundraising. There were managers that started their fundraise in 2019, early 2020, and got things done. But other than that, haven't seen a lot of big fundraisers and closings in 2020. As far as 2021, I think that will make up for 2020 and could possibly be a record year within our portfolio. We're seeing quite a bit of managers in our portfolio coming back out to market. Presumably, we could do all of our 2021 commitments and allocations just from re-ups from our managers. And we're at February. Our expectation is even more of our portfolio will be fundraising in the back half of the year. So 2021 will be, I think, a big year for fundraising. Pause there for any questions on market environment. Moving on to page 20. This is returns for private investments. You can see on the left side, I think John and RBK have already covered this, relatively strong returns for our portfolio. My expectation is that the 1 year number was a pretty good number. 2021 will be even better. A lot of our managers have written up their portfolios in a conservative way for the year. The portfolio has held up quite well across the COVID landscape. We have, our managers are indicating that they are pushing for exits in 2021, hiring bankers. And so I expect next year we'll see further markups and exits in our portfolio and an acceleration in exits and performance. Private investments relative to the benchmark for Jeff and Mark. I think the red here is a little bit misleading. If you're looking at just absolute performance, quite strong. If you're looking at against the benchmark, you're seeing some red. That's really a reflection of the benchmark, which is a public equity benchmark, we've been in a bull market. And also the benchmark is historically was S&P 1500 plus 400 bits on top of that for a liquidity premium. And so, you can see since inception, the private equity portfolio has beaten this public benchmark with a 400 bips premium on top of that. So I would say overall, everyone said this before, but private investments has been accretive to the portfolio. Page 21. This is just a recap of the portfolio. Very North American, US-centric portfolio. Bullet point 3, direct versus fund of funds. Fund of funds are essentially funds that invest in other funds. Historically, this number had been higher. As we've ramped up the portfolio, it's gone down, and we've been doing more direct or primary fund commitments, and would expect that number to continue to increase over time. Net cash flow profile, a positive $45 million for the quarter ending the year. I think this is kind of a backlog from the year. I've tried to communicate this to the board that we should be expecting, most likely a negative number for net cash flow as we've been increasing the size of the private investment portfolio. And so we would expect more drawdowns rather than distributions as we're increasing the size of the portfolio and putting more capital to work. So this was a positive number for the end of the year. No new commitments during the recent quarter. I will say you should expect more commitments from our group. We've been holding off on committing anything. And the first couple months of the year, we've been asking for year-end numbers from our managers and refreshing our attribution and data before making any new commitments. But you should expect acceleration and more commitments from our group over the coming months. And I will stop there for any questions. And if there aren't any, I'll hand it over to Ethan.
Any questions
Thanks all.
for Michael? Nice to see you, Michael. Thank you. Oh, Mark's got something. Hang on. You're muted, Mark.
Sorry.
There we go.
So back on your slide, you're on page 21 on bullet number 3, the direct versus the funds to funds, that you said that's changing. Is that a change as a result of manager selection, or is that just a change in strategy that you're undertaking?
A little bit of both. You know, I'd say historically, maybe the fund of funds were more in a quarter of the portfolio. And that is really legacy exposure. And so the fund of funds number has been going down. The direct funds has been going up. And so that's really a reflection of, you know, top-down strategy from the group and the board, where we want to hold the relationships directly with our fund managers instead of using an intermediary such as fund of funds.
Right.
Not that we will get rid of fund of funds completely. You know, I think it's still valuable for certain asset classes, such as maybe our Asia exposure, where we don't spend as much time on the ground there. So they're a good resource and a way to gain exposure, maybe for venture funds, which is a pretty niche and relationship focused industry, where we can't write very large check sizes into the best funds. And so there's capacity constraints. And so, you know, I would say the bulk of our exposure today in fund of funds is really for exposure to Asia and venture. But you could expect that number to likely decrease over the coming years.
Okay, but historically it's been running around 25% fund to funds. That's what you said?
I would say so.
Okay.
At least in my tenure. But Ethan can opine on that for, you know, even further back. I would say it's been kind of running about 25%, and we've gotten it down to 20 now.
Okay, thank you.
Anything else for Michael? Okay, I think Ethan, you're up.
Great, thanks, Mr. Chairman, members of the board. Just quickly before I jump in, Mark, do you have any other questions about fund of funds exposure and expectations going forward?
No.
Okay. All right, great. Well, I'm on page 22. I'll be covering real assets and real estate first. I won't walk you through all these individual bullet points. Maybe just draw your attention to the summary points. You know, real estate has been very varied in its behavior over the last 10 months or so. Transaction volume has been severely depressed. The debt and financing markets are still open, but very cautious and conservative. You know, generally speaking, across real estate, values are down, but that just depends on the property type and other nuances, location, you know, vacancies, et cetera. REITs got whacked, but they're fighting back, and the fundraising environment remains very strong, and the dry powder remains at elevated levels. Certainly happy to address any specific bullet points or other questions that you all might have about the current real estate environment.
Ethan, this is Jack. Just on a portfolio level, I'm always kind of trying to understand our risk. Would you say, as a result of the environment we're in, the risk in the real estate portfolio and the risk is I consider non-performance or not meeting our benchmark, has that gone way up?
Truthfully, yes. And I'll relate that to one specific concern I have, and one that's been a concern of mine for a while that I've been deliberately trying to address vis-a-vis our, you know, strategic decisions. But, you know, maybe I'll hit on a couple of points. Hotels, not a big issue. We had, I think, just about 2% or less exposure there. So we rode through that very well. When you think retail, that got whacked pretty good. Most of our exposure there, thankfully, was in grocery anchored infill retail. So think needs based. People still bought groceries and ate food during, you know, the depths and the lockdown. COVID's still going on obviously. We did get hit in one of our core funds, in particular, two of them in particular, with some of their mall exposure. But overall, we rode through that storm pretty well. But we do have fairly significant office exposure, Jack, and that is a concern for sure. I have deliberately not looked for us to commit to office funds for a number of years. There's a couple of things going on there that were in existence pre-COVID, that being office has more operational complexities. They also, as a result of that, require higher capital expenditures, which means they have reduced net operating income margins. And so have been deliberately moving away from that. We have allocator funds, managers that will invest across all property types. So we'll never fully move away from office, but I've been trying to grow our exposure in multifamily and industrial, for example, to offset that sort of overweight position we have in office. And it's the whole work from home dynamic that is still developing. I think it was during perhaps our last board meeting or the one prior to that where, it's still greatly unknown as to how office will be used in the future. I'm already seeing anecdotal evidence of offices being reconfigured into multifamily, for example, and other uses. Office using tenants are starting to sign shorter term leases versus longer term leases. And so that existing office exposure that we have is a concern and could be a reason for underperformance going forward. But I would say, the jury is still definitely out, but I would expect some impact for sure. It's just at what level I have no idea, and it's very hard for me to determine. But, certainly as that dynamic continues to unravel and more information is known, rest assured by all means be reporting on that. But stay tuned.
Okay.
If there are no other questions, we can move on to slide 22 and just briefly touch on performance. I think there's been a fair amount of discussion on this already from RVK, from an attribution perspective. Largely what drove the last year's underperformance was a REIT exposure. They have bounced back. They were down 7.5% for year 2020. They're up year to date. They had a bad week last week, but they're fighting back. And if you think about yields on a relative basis, they're still a pretty good place to be, given their property type diversification and exposure to some of those more growth-oriented property types that benefited extremely well during the crisis and continue to benefit, things like data centers and cell towers and net lease and so forth. But certainly, my expectation is to dig out of this since inception relative to the benchmark return. I've been trying to dig out of that since getting here, and we're, the last handful of years have been a pretty good example of that. We've had double-digit returns for the most part over the last handful of years, and we continue to slog it out. So happy to address questions. Otherwise, we can move to slide 24.
Move on there.
Great. So a lot of this speaks for itself. Maybe I'll just highlight, negative cash flow of 42 million. That was largely driven by a lot of funds that we've committed to recently. So just natural ebb and flow of drawdowns and distributions. We touched on the Stockbridge Niche Logistics commitment of 80 million yesterday. We added $20 million to CBRE Strategic Partners US Value 9. CBRE has been a long-standing relationship of ours. They're one of our highest conviction managers. We committed 30 million to them in 2019. The fund was still open. They had made some great acquisitions pre and post-COVID, primarily in the multifamily and industrial space. And it was a good place to park additional money and increase that overall commitment to 50 million. We did make an additional $20 million investment into a cold storage private REIT. We had an existing $8.5 million position there. This is the largest global cold storage industrial property operator in the world, and they have been performing exceedingly well. We upsize our investment here because of their financial performance and because of the tailwinds in the space that were existing pre-COVID and just accelerated during COVID. And then we took advantage of the REIT markets to tactically add, two $25 million slices to our publicly traded REIT mandate, one in December, if I'm not mistaken, and then again late mid-January, if I'm not mistaken. I could certainly get exact dates for you if you're interested. And then, just high level, we continue to focus on our high conviction managers, bigger, fewer, stronger relationships. Still working on some separate account mandates to basically, buy well-positioned portfolios with strong cash flows and hold them for much longer periods of time versus experiencing those frictional costs of buying and selling real estate, experiencing the reinvestment risk of having to then go out and, find deal flow and attractive deals with a separate account. You're the single investor alongside the investment manager. You're aligned economically, you're aligned strategically. You can buy good assets, hold them, raise rents, create long-term durable cash flows that are ideally accretive to our actuarial rate of return and hold those cash flows for very long periods of time, if not perpetually. So I'll pause there. Leverage is all within investment policy constraints. Happy to address any specific questions on these bullet points or anything else.
Ethan, this is Jeff.
Yeah.
I have a question for you.
Sure.
So the $50 million investment in publicly traded REITs, were those in specific sectors?
The short answer is no. The REIT mandate that we maintain is a diversified public REIT mandate that is benchmarked against the MSCI REIT index. So very well diversified across all property types and sectors. Maybe a couple things before we move on. I'll just note that, given what happened down in Texas and so forth with the polar vortex that extended that far south, no major concerns, no major issues in any of our properties. A couple of burst pipes, et cetera, all fell under, catastrophic insurance policies that were already in place. All's covered, no material issues there. So that's great news. And then certainly, I know John had mentioned the lofts, the Nashville-owned property that was basically at ground zero of the Christmas Day Nashville explosion. I believe he might have showed you a picture or two. 6 standard deviation event. That's why we have a very diversified portfolio. As a percentage of overall cap, it's about 4 basis points or less. As a percentage of our real estate NAV, it's less than 24 basis points. Everything was covered under insurance. All leases have been terminated. All lost rents have actually just been paid as of the other day. I think Monday, in fact. The policies that they hold will cover reconstruction, demolition, any lost business revenues and income. So well positioned there. It's just unfortunate that they'll have to basically rip it down, rebuild it. And so the hold on that particular asset has been extended by anywhere from 18 to 24 to 36 months, but covered financially and just keeping an eye on things. Any questions before we move on to real assets? Sorry, yes, Carl?
I have a question about just in terms of staff time, when something like that happens, you're obviously kept informed, but that can be a very time consuming thing dealing with the insurers. Is that the manager's
That's exactly correct, Carl. That's the manager's issue. That's them rolling up their sleeves. That's their time and attention. From my perspective, it's literally just an email note to them, once every couple of weeks to give me a status update.
Okay, thank you.
And they'll, of course, report any updates in their quarterly reports, but, that's not timely enough, I guess, for me. I want to make sure that they're doing everything they can as timely as they can to keep our investments on track.
It's very conscientious of you that when our buildings get blown up, you would like to know. I appreciate that.
If it weren't for COVID, I probably would have hopped on an airplane and flown out there and seen it for myself. But, the city kept anyone from coming into the building for a number of weeks afterward, as it was an active crime scene and the structural integrity was in question, and the building was subsequently condemned and has since been torn down. But yeah, happy to do it. That is my job and fiduciary duty. So that's the least you can expect from me.
All right, well, good.
You would have asked to fly out. I think I need to clarify.
Anyway, real assets?
Real assets. I'm on page 25. Again, I won't go through these individual bullet points, but maybe the last one I'll draw your attention to, to your point earlier, Mark, not only oil prices, but equities in the energy space have been on a tear of late. The best performing sector in 2021, I believe. That's largely driven by the oil prices being up so significantly since the lockdown and the price war between Russia and Saudi Arabia. Prices are up even further from these prices I have quoted here. But MLPs, which we have a significant position in, do remain depressed. Oil demand and production are recovering. Log prices, timber, of which we have about $100 million of NAV, have increased. Lumber in particular is at all-time highs. The housing market is very robust. The December numbers just came in and were beat even last November's numbers. And dry powder is very healthy. I'd say just briefly, what used to be sort of a oversupply issue with constant levels of demand that were driving oil prices down has flip-flopped and turned into an undersupplied issue, or a supply issue that has really reversed course given COVID and the lockdowns, and then the economy opening back up, coupled with increasing demand as a result of that. So there were tons of shut-ins. The oil patch basically shut down, and then has been slowly ramping back up. That's why you see prices doing what they're doing. But happy to answer other questions about these bullet points or anything else in the space.
Ethan, going forward, is there a particular type of asset in this group that you're looking at to increase our exposure with?
In real assets in particular, yes, absolutely, Jack. I mean, I was planning to touch on that later on, but definitely shifting away. We won't entirely leave the oil patch. Oil and gas is not going away. While there's been a lot of talk about the energy transition and renewables is certainly on a parabolic growth path right now relative to, onshore oil and gas. There's a lot of things that people don't think about often that oil is used for, like plastics, for example, which is used rampantly throughout the world. Asphalt for road building, for example, tires that are on your cars. So while I'm de-emphasizing oil and gas for sure going forward, definitely looking to diversify away from that. And that comes in the form of currently things like regenerative agriculture that is focused on native wheats, grass-fed beef, carbon sequestration, for example. We're looking at, Jeremy and I just had a call the other day with a group that was actually, I guess I was the only one on the call, but we were looking at shipping containers that travel the globe and ship goods all over the world. We have a call in a couple weeks with a group that buys and sells and operates rail cars. So again, more correlated to the economic cycle, but definitely huge income component and a real hard asset there, for example. But really also looking at, and the primary focus, I'm deeply involved in a deal right now is renewable energy development. There's all sorts of accords around the globe. This is, there's, talk of getting to net zero globally by 2015. We'll see if that happens, but global renewable power sources will deeply affect that. And so spending a lot of time talking to folks who are developing, actually ground up development, taking on the construction technology, engineering risk to develop and deliver these projects, and then, deal with credit-worthy off-takers to put in place 15 to 30-year purchase power agreements. So very predictable, durable, contractual, inflation-adjusted cash flows that will, give us 6 to 10% current cash on a distributable basis. I'm not spending a lot of time looking at buying those existing projects. So looking at funds that would go buy a 1 gigawatt solar array. The reason for that, you might ask, is because a lot of the value creation occurs in the sourcing, identifying the project, the location, and then building that project and putting the purchase power agreement in place. And so there's a massive yield compression, which means the values go up dramatically when they sell that finished project into the sort of operating, already developed market space. And there's a crush of capital in that space globally looking for those projects. And because of that yield compression, you're looking at 3, 4, 5% yields on a current basis, which on a relative basis, if you compare those to treasuries, is quite attractive. That's a pretty significant spread, but that doesn't help me beat our actuarial rate of return. And that doesn't help me get us to a point where, we're more secure in paying our long-term liabilities. I know I said a lot, but maybe I'll stop and see if I addressed your question or if there are others.
So does that mean you're getting in those kinds of arrangements earlier than?
I'm sorry, Carl, that was a little bit.
The way I understood what you just said is that once there's a lot of work that goes into that before they're ready to go and generating returns. Once they're at that point, the return, because there's so much money looking for those, the return is low. So does that mean we're taking more risk by investing early?
So yeah, that's a great question. And, you can think about the answer to that question in a couple ways. I guess, to be perfectly frank, the answer is yes. I mean, there's always increased risk when you are developing and permitting a project and dealing with technologies and dealing with third-party construction contractors and engineers and technical advisors and so forth. But if you find a group that has a track record of doing that and doing that successfully over a number of years, or came from an environment where that's what they did for their entire careers in an industrial operating fashion prior to shifting gears and raising private equity oriented funds. I'm speaking specifically to a group I'm talking to now, and is part of the reason why I'm getting on an airplane on Monday. That really is what I view, that risk is mitigated because they know the players, they know the contractors, they deal with maximum guaranteed price contracts. So any contractual price overrun is shouldered and is the liability of the contractor. If you find a group that can manage all those risks, that's a real value add in my equation, and they know how to mitigate it and manage it, and is a reason to spend more time getting to know those folks, specifically because they've done it so successfully for such a long period of time. But if you went with a group that's never done that before and was developing stuff from the ground up, didn't have experience in the past, that would be a huge risk and something that I would, turn my back on and run for the hills from.
Thank you.
Yeah. Other questions before we move on to page 26? Great. So here again, performance speaks for itself. Don't need to reiterate numbers here, but again, this was largely driven by our public MLP exposure. Mark, to your point, at the end of March, the MLP market itself was down 60%. It has since battled back and ended the year 2020 down 29%. So it did rally back quite a bit, but it came from a very low place. Year to date through 131, the MLP market's up almost 6%. Our account's up almost 5%. So back in positive territory, at least for the year. And while we continue to battle back, yields are current distribution yields, although we are reinvesting them for that particular account, are in excess of 9%. So very strong yields there. There's also a lot of J-curve activity in here. We've got a couple of relatively new funds, Kimmeridge 5, Mountain Capital 2, Silver Creek Aggregates Fund that are just pulling this down as well. But if there are no further questions, we can move on to page 27. So here, sort of have the overall real assets portfolio broken out. I would expect this breakout at the top to maybe change a little bit, just from a categorization perspective. Currently, our investment policy statement has the real assets broken out by TIPS, infrastructure related, and commodities related. I would maybe foresee energy and timber becoming, sub bullet points under our overall commodities exposure. TIPS will be what it is. Broad natural resources would probably be a sub bullet point under infrastructure or commodities, depending where that breaks out. But just an FYI and an expectation going forward. Again, very North American centric portfolio. We had some negative cash flow that was driven by just large capital calls for some of our newer funds. We had no new commitments since last meeting, and our timber leverage is 6.2%, which is well within our range of 0 to 30. Happy to take any questions.
Thanks.
Okay, thanks everyone. Really appreciate it.
Core 6, John.
Hey, Carl, briefly, if I may, I apologize for stepping in, but maybe, again, with the Texas freezes and so forth, there was a lot of disruption in the oil patch down there. Pumps broke, some wells got shut in, companies closed, service providers were prevented from servicing things. We did have some disruption from a revenue perspective, some minor property damage with burst pipes, pumps cracking and so forth, but nothing material that will impact the portfolio in a real material way. So just wanted to impart that to you all. Thank you.
Thank you. And John, before you begin, so I think it's good that we're taking our time going through this, but we're getting behind schedule. So why don't we push the tab 10? Why don't we push that discussion off till March 23rd? Does anybody have a problem with that?
Yes, I'm worried that how much trouble I can get in between now and then.
Well, the good news is that you've been on the board a long time. You haven't gotten in too much trouble. And I know that Mark and Jeff have already gotten a chunk of this.
Yep, we got it.
So as long as you continue to behave like you've been behaving, which of course is always a you know, double-edged sword. But I think we'll be okay.
All right, yeah, that's great.
Just
Mr. Chairman,
call me
if I-
if you're gonna do anything silly, Jack.
yeah. Mr. Chairman, if I may, just for 30 seconds, I agree. I think it's an important enough topic that we would be doing you a disservice if we cut my presentation short, and that goes directly against the fiduciary duty discussion that I want to give. So
Okay.
I think it'd be great to push it back till March.
All right, and Mark and Dan, both Dans, people who have experience going through these administrative rule change hearings have promised me that part of our agenda will take very little time.
Agreed.
So, if it takes longer than that, it's not my fault.
Plus, meet Dan White.
Right. Right. Okay, so John Ramasco?
Thank you, Mr. Chairman. I'll refer the board to slide number 28. Won't go over the environment in detail. I'm just summarized by saying COVID caused spread product and structural spreads to blow out dramatically in the early part of the year. The Fed stepped in, squashed the front end of the curve, backed up a dump truck load of liquidity to the market. And so both credit and structural spreads finished the year about where they started. Barclays Agg returned 7.5% basically because the Fed drove down interest rates. Going on to slide number 30, you can see that the core fixed income returned 8.25% for the year. I think well above where any of us would have guessed it would finish at the beginning of the year. Major contributors to that were our asset manager Reams, who had just a stellar year at 17.1% return for the year, as they were able to take advantage of volatility in the market. TIPS performed exceedingly well as the expectation for inflation declined significantly, and the internal portfolio performed just slightly above the benchmark. The portfolio was a little more than $2.25 billion at calendar year end. Duration was approximately 93% of the benchmark, a little shorter than we've had it historically, partially due to preparations for asset reallocation, just having more cash on hand, more liquidity on hand to reallocate. At the end of the year, the portfolio was underweight treasuries and agencies and overweight spread product, mainly corporate bonds. Happy to take any questions about core fixed income.
Haven't we, has Reams always been, I mean, weren't there times when we were looking carefully at Reams in terms of being an underperformer?
Yeah, I'll make some comments and then defer to the public markets team. Reams has historically been a player that performs well in volatile markets. And so quite often, in the case of the year 2020, they entered the year dramatically underweight spread product, dramatically overweight treasuries. then were able to reverse that position during the year, take on a significant weight to spread product, and then close a lot of that weight out later in the year as they recovered. We saw exactly that same dynamic back in 2008, where they did the same thing at that time, mainly with commercial mortgage-backed securities, where they put close to half of the portfolio on commercial mortgage-backed securities that performed exceedingly well at that time period, and put them in a position of outperformance for a significant time period. Although in that that interim period, they generally had an underweight to duration and an underweight to spread product that caused them to give yield to the market. And so they bled for a while. And then I would defer to Randy and the public markets team for more specifics.
Thank you.
Yeah, this is Randy. I think John gave an excellent description of that. We look at Reams as kind of our alpha seeker, if you want to call it that, in this fixed income area. And they do take big positions. They were defensive for a long time, like you said, and then it paid off for them. Then they reversed it. So one of the advantages of having a external portfolio manager like this is for working for us is that they take a much more aggressive posture than say we can with an internal portfolio that John's managing. And so it gives us a good read on what a type of manager like that is seen out there in the markets. And then, it can create discussion among ourselves on how John wants the fixed income portfolios to be positioned here as well.
Thank you. John, you're back up, or are you?
Done with my comments, and unless there are more questions.
Okay, any questions on core? Okay, do you want to keep moving along? You want to take like a 5-minute break?
I'm okay for keeping moving on, but.
Okay, let's just keep moving on then, unless. So Randy, you're up.
Okay, thank you, Mr. Chairman. I've chimed in a few times here already in the board meeting, but I would like to introduce myself to the new board members. I'm Randy Muffick. I'm the head of public markets. I grew up here in the Board of Investments. I was an investment analyst right out of college here. And then I went on to the big city of Seattle for about 6 years and worked in the investment business over there before the mountains called me back and I couldn't refuse. So came back to the Board of Investments, ran the internal stock fund that we had here for about 10 years. And then in 2007, we decided to diversify our equity holdings among external managers, and been the head of the public markets team since that time. As far as non-core fixed income, made some comments there on page 32 about spreads. High yield spreads are a real indication of how investors are perceiving credit risk out there. And so as spreads are narrowing, they continue to narrow. It shows that investors are becoming more and more confident in the creditworthiness of particularly the more balance sheet stressed companies out there that issue high yield bonds. Probably the most interesting thing that's happened in the high yield markets here in the last few months or so is that default rates as they came in for 2020 were actually substantially better than what a lot of the experts had thought out there initially. Because of COVID and its effects on the economy and the energy space, defaults were expected to be in the 8% to 12% range in high yield, and they came in at 6.2%, which thanks to the Fed, as John mentioned, bringing out a lot of liquidity into the markets and helping provide liquidity so that companies could access the fixed income markets. Going forward, having talked to our managers as well as looking at the literature out there, the default rates in high yield are actually expected to improve even more in 2021. In fact, it could be as low as 3% in 2021, which would be pretty much back to normal. So as you can see, just kind of looking at this slide and hearing me talk about it, how things are improving in the economy and in the credit markets. And, you know, a lot of that's, you know, due to the Fed helping out, but of course, also getting, you know, we're closer to the end of COVID than we are at the beginning, I guess you should, I should say.
You hope anyway.
Yes. Next slide, please. This is the performance of non-core fixed income. You can see pretty solid single digits across the board there in non-core. And then if you look at the relative performance, red across the board slightly in all those areas. But keep in mind that we ask our managers to err on the side of being more defensive, I guess, in this space. And so they are not in the riskier assets and the riskier credits. And those riskier credits have done quite well for quite a while. And so that kind of skews the relative performance there versus the benchmark at this point. Slide 34. Again, I mentioned the defensive nature of our high yield portfolios. Nonetheless, they still returned a solid 6.4% for the calendar year. One of the interesting things, I think it was mentioned yesterday by RVK, is that the investment grade markets, the core markets were up about 8.5%. And so this is one of those years where, you know, high yield actually returned less than the investment grade markets. And that's due to the fact that the high yield credits are usually shorter in duration, and the move in interest rates due to the Fed and COVID caused the longer duration investment grade bonds to actually outperform the high yield bonds for the year. Let's see, 150 million new into the non-core asset class. That was the 75 million into the preferred securities portfolio and 75 million into the new emerging market debt portfolio. Next time around, as we build out this non-core fixed income asset class, we'll have more to talk about as far as the preferred securities and emerging market securities portfolios and their respective areas in the market and how those went. But we're so early in the history there that next time around is probably the most appropriate time to start to talk about those as well. So keep in mind that, you know, non-core fixed income now, there's high yield bonds, there's preferred stock, and there's emerging market debt. And that's where we kind of stand there with, you know, building out and diversifying this area. Next, please. Lindsay, thanks. Well, I guess that's domestic equity. So are there any questions on the non-core fixed income asset class at this point?
Okay, Randy, move on. Oh, wait a minute, Mark had something, sorry.
Just, you got two new plays here. You got preferred securities and emerging market. Am I understanding that's new for the board? Those two plays?
Yes, those two portfolios are the first time that we've had portfolios on those particular areas, correct?
Okay, all right, thanks.
Okay, anything else? All right, Randy, we'll move on to domestic equity.
Okay, domestic equities, great year, as you've heard. Started out pretty well, then, you know, really went to hell in a handbasket and then came screaming back. Probably the most notable thing there is that, as Bruce asked earlier, that yes, the market continues to broaden out. It continues to broaden out to this day. I've talked a while last year about the mega cap technology stocks that are so much a part of the S&P 500, for instance, how they were basically determining the performance of that benchmark, and therefore, if you were more diversified than just owning those 5 stocks, you're kind of working against yourself. So now, as we're got the stimulus working. We're working towards the end, hopefully the end of COVID. Investors are looking around and they're basically rotating into some of these other areas that were so damaged by the COVID economy, and they're rotating back into those stocks. So that's what we're seeing even today, where the NASDAQ's down. The Dow continues to outperform the NASDAQ. So money's rotating out of the tech stocks, particularly the mega tech stocks, and also some of the stocks that benefited from the COVID world economy, and they're moving into the recovery, reopening type plays, which is actually pretty good for active management, I think, because nobody wants to have all their money in just 5 stocks, no matter how good those companies are. So as things broaden out, active management is picked up, and you can see that in the numbers from yesterday that RBK presented, that for the quarter ended and the fiscal year ended, that domestic equities, that our asset class, actually outperformed its benchmark for the first time in a while. Looking at page 36 here, you can see the total returns for domestic equities, and that's why we like to be in domestic equities in general, because you get pretty solid returns across the long term. Relative performance, slightly red, as you can see across the board. A lot of it has to do with the narrow market that I talked about, and that's largely also that it's getting harder and harder to outperform in large cap stocks, and has been for quite a while, because of the efficiency of that part of the market. And that's why we have that largely indexed in this asset class, as well as the international asset class. Next slide, please. There we go. Things to point out here. There's, like I said, the market's broadened, so the performance has improved, particularly with Jacobs Levy's portfolio in the quarter. We funded them in early October. We added $50 million to them, and turned out to be a pretty timely example there of how reopening trade can work if you move to a portfolio like that. And expect to see those type of actions, I guess, with those types of portfolios going forward. Next. Here's our lineup here as far as relative return versus their individual benchmarks. Diane, I think you had a question on small caps and why they pulled down the overall performance somewhat in the cap. And the reason is basically, you can see right there is DFA had a very difficult year on the left there on the 1 year box there. They were down 8% versus their benchmark. A lot of that was because of they have more of a value tilt than their benchmark, and the value stocks did not do very well for most of the year. They're starting to turn around, but that is basically your answer, Diane, that DFA had a very difficult year for us in 2020.
So just, I realize manager selection isn't a huge issue, but is this a reasonable retention of that manager? And how do we decide over time when it is time to not use a manager?
Very good question. I can't go into a lot of detail on that right now, because this is one of our discussion points among public markets, along with John, on whether this year was something that is an aberration or something that is more systemic. And that's probably the way I should leave it at this point. The other answer to your other question about how do we know how to leave a manager, that's always, there's some art to that. You can have some protocols as far as performance numbers and such, but there's other things that enter into that. We have a scorecard that on all our managers that the analysts keep that rates them in 9 areas that we keep track of. So we look to that. We look to the performance and the relative performance. And it's a combination of those things that leads to a decision. There's not a particular time limit in there. We like to give any manager that we hire, we like to give them a full business cycle to prove themselves and be patient with them. But that's not always the case either if something falls apart, for instance, in the scorecard rating.
So I guess my question is, who are the team members that take part in that? Is RVK actively involved? How does that work?
Yeah, we have our public markets team. That's myself and Jason Brent and Steve Strong. The CIO sits in on our discussions on these type of things as well. RVK will give their opinion if there's a particular change with a manager, either like our management team or ownership, or if there's a big move in relative performance. They are open to contact us, which they do, and we also have the ability to contact them as well and ask them what they think on these particular managers too.
So you're confident that our process is working as it should?
I do, yeah. I think if you look at our numbers for the domestic equities versus other plans out there, we're right across the board in the top third or so. And the international equities, those we've been across the board ahead of that benchmark there. So pretty confident, very confident in the process that we have right now. And it's never a perfect process. It's managing managers is somewhat like managing a portfolio of securities, where there's going to be times when you wish you would have not hired somebody, and there's going to be times when you wish you would have not terminated somebody, or held on to somebody for a longer period of time maybe than you should. So bottom line is here, we try and be very patient with our managers, but if somebody has something go wrong with their performance in particular, like in this case, we take a look and see if there's particular market dynamics that have caused it, and rather than the manager's style happens to be out of favor, rather than that the company's broken or the management of the portfolio is not being implemented properly.
Thank
you. Yep. Next slide, please. This is a longer term picture here. You can see the 10-year numbers to the right there. And all these managers that we have right there listed, they've been with us for 10 years plus. That's why they're on that chart there. And you can see that all of them have added value except for DFA at this point. And DFA's 10-year number just kind of dropped below being green there because of the difficult year that they just had. Slide 40, please. Not much to say here. Yes, we are slightly overweight small caps, as Aaron mentioned. We're typically slightly overweight. So that remains, that's really working for us well, even as we continue into 2021, as small caps are on fire. And, it's good to see because, they had a difficult beginning of last year. But this asset class in particular is subject to more inflows and outflows in some respects, more outflows, I should say, in some respects than others, because these assets are liquid. They're the biggest portion of the asset allocation. And as equities do well, John trims back in rebalancing. And so that was done this quarter to the tune of $100 million in outflows, and 25 million of those dollars came from out of the BlackRock portfolio, and 75 million came out of the Northern Trust portfolio. We try and, when we move money, we try and take the money out of our passive funds if we can, because that's easier to do with as far as effects on managing the portfolio than taking money away from an active manager. That's not to say we won't take money from an active manager, but in this case, we elected to take the 100 million out of those two large passive accounts. And then I mentioned that $50 million in early October went into the Jacobs Levy portfolio from the passive accounts as well. And that was in the first week of October, and Levy's done very well. The portfolio's been done very well on a relative basis since then.
I have a question, Randy. So when you say you move money out of the BlackRock portfolio, is that the large cap portfolio that you move it
Yes.
from? Okay.
Yeah, we should probably be more specific with that on these slides next time around. But yeah, the large cap portfolio that's a little over $1 billion.
The one with all the money in it.
Yeah, the big one, the big portfolio, that passive portfolio. Okay, any further questions on domestic equities? Okay, seeing none, hearing none. International equities, a lot of this is the same story as domestic equities. International stocks rallied solidly for largely the same reasons that domestics did, with election being over, the Fed working in favor, fiscal stimulus, maybe even more fiscal stimulus coming, and working towards the end of, hopefully the end of COVID with the vaccines that are coming on the market. What's noteworthy here is that international equities in the fourth quarter outperformed domestic equities as far as rate of return, which is the first time in several quarters that that's been so. International stocks have lagged domestic stocks for the better part of 10 years. And I think this is part of the broadening out trade, the reopening trade that I talked about earlier with domestics. That, you know, not only are investors looking to own something other than 5 big tech stocks, but they're looking to own something more than 5 big American tech stocks. And so we might see this for a while. I don't know if it's a trend that'll stay in place for, more than a few quarters or whatever. But in the meantime, that's why we're diversified among both domestic and international stocks, is to get, to get the returns from both markets, because, sometimes one market will lead another market. Let's see what else. I guess I should say something about valuations. I didn't say anything about valuations on the US market, but valuations are still expensive in international stocks as well as domestic stocks. I've talked about this for a while too, in that, those valuations could be okay as long as the recovery is to the strength that what investors are expecting. And so far it has been, and might even be a little bit better. And so the markets continue to grow into those multiples that people use to value stocks. And so far, so good. Now, as interest rates continue to edge up, as they're starting to edge up in the fixed income markets, then, that's going to put more pressure on what people think stocks should be valued at as well. But so far, things are improving. The stock investors have anticipated it, continue to anticipate it, and they're basically just moving from one part of the equity markets to the other, as far as, tech to other areas, COVID to non-COVID type areas, and from US to international. Next slide, please. Here's the returns, net performance. You can see the total returns for international. Not quite as robust there in the 10-year and inception as the domestic equities, and that's because of the long-term lagging versus domestic equities that I just spoke of. That might be turning around slightly. But on the right-hand side there, we've had very good relative returns versus the benchmark for the international equity asset class. Part of that is because the international equities markets still have a bit more to offer active managers as far as alpha seeking, you might say, excess returns to see, because the markets still aren't quite as efficient as the US markets are. Slide 43. Again, great performance the last 12 months. We've had some portfolios that have done very well. Bailey Gifford, our growth manager, showed up in the attribution that Aaron spoke of, and had a great year outperformed by almost 20%. Really good to see. Those guys are long-term investors and continue to be exactly what they said they were when we hired them. Small cap, overweight, helped a little bit, but not enough to really register anything there on the attribution for this particular asset class. Next. Thanks. Here's the 1 year and 3 year for the managers in the international space. The longer term numbers are more important as we go through this. Anybody can have a bad year or even, be out of favor for 3 years or make some mistakes that hurt them for 3 years. So as you get further and further out, you should want to see more and more green. Slide 44, please. And here's our longer term numbers here. The thing to remember here, I guess, is on page 10. We only have 2 managers in this space that have been with us for over 10 years. That's because we did a major restructuring back in 2012. That turned out to be pretty good overall with the numbers that you've seen. You see some of our managers in the 5-year area, that's more appropriate because they've been with us now for over 5 years, but they don't show up on the 10-year. You can see some of them are lagging a little bit to the right, but again, overall, if you put those numbers together, the asset class has added value across the board. And final slide here. Not mention here, we're still slightly overweight small cap, similar to the domestics, as we like to have that bias in place for the most part. Again, keep in mind that we have a significant large cap passive weight in this asset class as well as domestics. That's by design. It's worked out well. Like I said, in large caps in particular, in these markets, particularly the US market, not so much international, but still some influence in international, that the markets are becoming more and more efficient, which means it's harder and harder to spot anomalies there for active managers to be able to buy and sell something that is going to do overall better than the market or worse than the market based on what the manager has assessed. And I think
Chair, whoops, I have if you wouldn't mind, go back to page 44. Looking at DFA again over time, and I'm still not comforted about their performance over time. So can you review for me yet again that particular small cap manager and that
Sure.
international manager? And
Sure. Yeah, Diane, sure. You're right on with this. One of the aspects of DFA, and we're well aware of this and have had discussions about this, is they're basically a quantitative model manager, which means they have a model that is being fed information, and they're using that to decide, what stocks to hold, what stocks to buy and sell and such. That model that determines the decisions in the domestic small cap portfolio is essentially the same model that is being run for these 2 international portfolios that they manage for us. So again, that's an example of, it's out of favor, has been out of favor. There are some changes that they made to that model a few years ago that we've been somewhat concerned about, suspectful about, you might say, because those changes that they made have not panned out quite yet. They probably will for the long term, but again, this is one of those gray areas with a manager that has stumbled that you reassess, and that's what we're doing.
And I assume that your timeline on reassessment is how soon will we be done looking at that timeline for reassessment?
Again, I can't give you a lot of information in detail on that, Diane, because we're in the process of making a decision, I guess.
Thank you.
Okay,
Sorry,
anything else?
sorry to be somewhat vague, Diane, but that's the best I can do here today.
Can I ask a quick question, Mr. Chairman?
You bet, you bet, you bet.
So Diane, you're focusing in on that one manager there. Have you raised that question before to the board?
No, just from looking at the charts this time to see the long-term performance.
Right, okay.
Well, varies. Thanks.
Okay, that's all I have unless there are any other questions.
Okay, anything else? Kirsten's back.
Thank
Hey,
you
good
much.
morning. Yeah, luckily we talked about STIP a lot yesterday. I don't have anything to add unless anyone has new questions after yesterday. Awesome. Well, here's a
Wow,
couple minutes
Kirsten,
back.
that's not right.
I like
Well,
it.
I'll mess it up. Kirsten, I have a question. Do you guys,
Sure.
this is Jeff. Do you guys have any exposure or any interest in taxable municipals within STIP, or is that outside your policy guidelines?
Yeah, we don't have it in our policy. And when I started at the board, I had asked also about in all of our fixed income portfolios about maybe adding those. And at the time it was John and I, and there is just not enough capacity for the three of us to do all the credit research involved in adding that. So currently it's not an option.
Okay, thanks.
Yeah, no problem. Maybe in the future, if you guys want to give us a couple
Stop.
more fixed income.
Stop.
Just kidding. Always got to throw that out there.
No, you guys just can't let it, oh.
We got our one extra fixed income person, Kirsten, and we're gonna have to be happy with that for now. I think it took us 3 or 4 years to get that, so.
Right, understood. Okay, great. Thank you so much.
John, state fund.
Yeah, can I please refer the board to slide 49? State Fund, I think, had pretty surprisingly good performance for the year, a little better than 7.5%, led strongly by equities that were up over 16%. Their bond, all their portfolio underperformed in the first half of the year, but we cut it all back and then some by the end of the year. You'll recall the board approved a new policy statement allowing for investment in high yield in the state fund. We had thank you, that was particularly good timing for that. We put 30 million into high yield in early mid-April timeframe. And then we also put another 5 million in, I believe, in May. Those for that time period, the high yield returned a little better, 13.8% about, slightly under what the benchmark returned over that period, which was about 15.8%. But please recall, Randy mentioned that we prefer a more conservative high yield manager. And also that when we gave the manager the money, it was a very volatile market, meaning that they had to put money to work when bid-ask spreads were very high. So I think they did a decent job of doing that, but still suffered to the benchmark in that volatile period. Total market value at the end of the year was 1.6 billion. Our duration was above the benchmark at the end of the year. That's more a factor of the benchmark changing than it is us making an active bet. We still want to increase mortgages, probably something closer to where the benchmark is now, which is about a third. About a third of the current benchmark is mortgages. We're just a little north of 11% right now. We were pretty aggressive in putting those on until mid-December when we saw the spread on that product just really kind of collapse into near record lows. And so haven't put any on in a while and are likely to not put any more mortgages on until we are seeing better spreads there. Finally, would mention that equities performed well enough that we were approaching the upper end of the limit. And so John sold 25 million of domestic equities shortly after the end of the year. Happy to take questions on the state fund.
Anything?
I have no questions, Mr. Chairman.
What? That doesn't seem right.
I was gonna ask John if things gotten a little easier in dealing with them over there, but that's probably not the right question to ask.
Yes, well, while we certainly miss the old administration,
There we
we're
go.
very happy with the current administration as well. Going, Mr. Chairman, if you'll allow me, I guess, to go on to slide 51.
You bet.
The trust fund investment portfolio. Not going to rehash the environment here. We saw strong performance in the second half of the year. Slightly underperformed, mainly due to our real estate holdings there, which performed positively, just not nearly as strong as bonds. You might recall that Ethan called out just very slight negative performance for real estate in the pensions for the year, and the difference between the pension and the trust fund real estate holdings is just that in the trust fund it's much more core, and so those didn't suffer to the extent that some non-core holdings. And then additionally, of the bond holdings, we did underperform just very slightly, mainly because of the cash drag that we had as we held excess cash to reallocate to other asset classes, well, to real estate in the case of the trust fund investment pool. Portfolio was about 2.7 billion at the end of the quarter. We've purchased, as of the day before yesterday, when I looked at it, we are about 14% of the portfolio in real estate. So we started slow, but we're able to catch up pretty well recently. Happy to take any questions on the trust fund investment portfolio.
You have a sense, John, particularly with some of these trust funds where the income gets distributed annually for, things. Does this, what happens in a big year like this to the funds themselves?
So the gains, the unrealized gains, we generally don't distribute those.
Okay.
What we distribute is the actual cash that comes into the portfolio.
Okay.
So So those big fluctuations, they don't necessarily see that, Carl, in their distributable income.
Yeah, I get it. I understand. I'm sorry. That was kind of a dumb question.
Somebody told me there was no dumb questions, but you know, they didn't go to class with Greg Mergenthaler, so.
Okay. Well, you've proven how diplomatic you are already. Okay, anything else on the investment updates? Anything on the, John? Anything on the appendices that you wanted to call our attention or anything like that?
No, nothing specific from me, Mr. Chairman.
Okay.
But happy to answer questions on anything.
Anything further from board members? If not, we've got a couple of policy statements to review real quick, and then we can be done. So, John, you want to take those?
This John?
Yeah.
The face of the organization.
That's right. Yeah, if there's a possibility, we could look at those memos on, sorry, bear with me.
Tab 9.
Tab 9.
Greenway and Yellowstone pipeline cleanup.
Okay, so sorry, I don't have those in front of me, but the Greenway Trail Maintenance Fund is a what we expect to be approximately $1 million fund. The funds will come out of the East Helena Compensation Fund, a fund created for mitigation of properties around the ASARCO smelter in East Helena. This was a entity created late in 2020, essentially an agreement between the governor and the Prickly Pear Land Trust to transfer from the custodial trust to the Prickly Pear Land Trust properties, including trails yet to be constructed, yet to be completed around property in East Helena. This fund will provide money to maintain those properties for approximately the next 25 years. Happy to answer any other questions.
Anybody have any questions on the policy statement for the Greenway Project Trail Maintenance Fund? If not, is there a motion to approve?
I would so move.
I'd second this, Jack.
Okay, and Terry, you move? Terry, was that you that
Yes.
moved? Okay.
Yes, it was.
All right. Any further discussion, comments? If not, all in favor say aye.
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 Any opposed? Motion passes unanimously. Move on to the Yellowstone Exxon Settlement Fund.
This was a fund that was created when the pipeline underneath the Yellowstone River ruptured in 2011, causing pollution. That pollution was cleaned up. This fund is to mitigate damages caused by that. It'll be mostly to provide increased recreational opportunities up and down, well, down the river, I should say, not up the river. It was a long time coming. We've been in contact with the Natural Resources Defense Program for many years on this. A lot of it was tied up in the legal settlement, which was finalized and approved in 2018. They being the Department of Natural Resources has spent down the fund from something like 12 million to a little north of 7 million now, but going forward foresees those expenditures decreasing and being protracted so that there is an opportunity to increase earnings by putting some of that money into the long-term trust fund investment pool.
Okay. Any questions on the policy statement for the Yellowstone Exxon Settlement Fund? Seeing none, is there a motion to approve the policy statement for the Yellowstone Exxon Settlement Fund?
I'll move.
Mark's moved, Diane second. Any further discussion? If not, all in favor say aye.
Aye.
Any opposed? Seeing none, the motion passes unanimously. We are going to defer tab 10 until March 23rd. Dan Villa, in terms of recap and staff to do, I don't see any things on there that we're not talking about for March 23rd. Do you?
Just adding any updates to the board on SOC audit findings from our vendors that will be done under tab 2 on a go forward basis. Did get a request to add some language in the glossary, some additional acronyms, which we love to throw around. Just for the board members, if your key cards to the building are not working, just let me know or let Peg know, and we will get on that and make sure that your you can buzz into the room, and then we will also get board members out the new org chart with photos prior to the next
right.
meeting.
Okay. Anything else, Mark? Did you have something?
Well, are we supposed to get this RFP language too?
Right, so that was my next point, Mark. If we're done with the sort of the miscellaneous to-do things, I just want to recap what I think we're doing on March 23rd, which is we have our rules hearing. We have to then make a decision that day on the change in the rules, if I understand that correctly. We're going to get, we have to approve the RFP for the custodial bank, which we will get beforehand. And then we're going to have our education on our fiduciary obligations. Was there anything else that you guys see on the agenda for March 23rd?
Possibly just, everything else we will take, I'll send emails out to the board to bring you up to speed on. And if there's something you want to discuss in more detail on the 23rd, we'll add it to the agenda. But outside of that, I don't think there's anything we need to schedule for right now.
Okay, are we looking at well, yeah, Mark?
Well, the only other thing that I could think of would be any legislative update that we should be aware of.
Yep, I'm going to send out another legislative update this week to the board. And then if there's something we need to do in person, we can do that as well. But I try to get one out, not frequently, but as issues arise. This is going to be a big week for us. The actuarial bill that I discussed yesterday has been scheduled for hearing, and the 2 China bills are up for hearing on Friday afternoon as well. So transmittal week is coming up quickly. I'm gonna have to rent the suit for the whole week, not just the day.
Okay, if our agenda is roughly what I described, rules hearing decision, RFP, and fiduciary, are we looking at a full day there, or what's your guess?
My guess would be, so goal would be to get you the RFP this week, early next. So you have plenty of time to review and get feedback, so we can get you a red line version to have in front of you for the 23rd. So I'm hopeful that the RFP language will be some conversation about why the changes that we built in were there, but any conversation pieces or red lines we'd have in the board's hands well prior to, so we're not doing the review during the meeting. The rules hearing should be fairly pro forma and relatively quickly. And the fiduciary duty presentation, probably 45 minutes to an hour. So I'm thinking we could probably get it done in a half day. Start late morning and 9-ish, 9:30, wrap up by noon.
You had scheduled in the email at 10 o'clock, so
Yeah.
that may
I think
change.
it's growing a bit at this point.
Okay. Well, it's true because we spent a bunch of extra time on the investment update, but I always feel we put that at the end and kind of short shifted anyway, so I was glad to see that myself. But, Mark, did you have anything to add?
Well, just a question on the RFP. Dan, is there any way that you can highlight those areas that you want us to focus on as far as changes in services or anything like that?
We'll put a cover memo with it when we send it to you to draw attention to those specific elements.
All right, thank you.
Okay.
Dan White had something really quickly.
Yes,
okay.
Mr. Chairman, just to be clear on the rules, it is the actual hearing for the public to call in and make any suggestions, objections, comments with respect to those rules. And then there's a comment period that follows that before we make any changes that we think are necessary based upon those comments, and then they're implemented. So it's the actual hearing that you're going to be overseeing.
Oh, okay. I thought someone said yesterday that then afterwards that at that point we were going to make the decision. It didn't make a lot of sense to me that was the case, but so we'll make the decision at the next board meeting then?
So look at the rules as you're able. If anybody has any questions, ask me. If the board thinks that there should be changes to those rules, that hearing that we have on the 23rd would be the opportunity to do that. And then that'll just be the one hearing before we make amendments to those and they go into permanent placement.
Okay, so when do we have to vote, yes or no on these changes, right?
Yes.
And when will we do that?
Dan, what do you think?
Well, if there's no comment to respond to on the 23rd, I don't know why we couldn't do it then. If there is comment, I think then I think we do it at the April board meeting immediately following.
Okay.
That sounds great.
Okay, but I heard Dan say that there's a comment period after the hearing.
Yes, there is.
So if you have a comment period after the hearing, you have to.
You can't vote. So here's what we'll do. We're going to do a Gantt chart to send out to everybody when we send out the RFP language in the cover memo. So we have a firm timeline on this.
Okay.
Based on the statute. That would be easier.
Yes.
Based on your timeline
I'm
today.
sorry, I didn't mean to. I was just trying to look at schedules here and make sure everyone's aware of what the schedule is. And then April 20th and it's one day, right?
Is that right?
What's that? Carl, I'm sorry.
April 20th and it's one day, right?
Yes.
It's not.
Is it? Well, I don't know that we have quarterly yet. Let me see.
It's not a quarter.
Lindsay, what's our? April's the
It's
one day.
I looked this morning.
Okay.
And it's the 20th.
Yes.
And it's one day, Lindsay?
This isn't Lindsay, it's Maggie, but I looked today and it was only one day.
Okay.
So just so you know, I'll probably come down for that.
Good.
All right. So now that we thoroughly confused that, is there anything else that we need to do? If not, thank you all, Jeff and Mark. You're officially veterans for whatever that means. And everybody be safe and we'll see you on March 23rd.
Thank you all very much.
Thank you.
Everybody.